It's the debasement of currency where gold goes to the moon. And for that, you need to see M2 growth. You need to see liquidity. You need to see central bank balance sheets rising. We're just not seeing that. We're seeing the opposite. So it's bad. It's a bad environment.
Good morning, everyone, and thank you for joining us here at the Daily Crypto. Another video for you guys is here, and this time we have Raoul Pal joining us. However, before we can pay attention to what he has to say, let's have a look at the Fear and Greed Index for today. This video was recorded at a time when the score was 22, which is lower than yesterday's score of 24. The price of one Bitcoin is approximately $19,500, while one Ethereum is currently selling for $1,325. Now that that's out of the way, let's get on with the video.
Unemployment is a lagging indicator. We're seeing more frequent data on employment suggests that it's weakening fast. We've seen the housing sector weakening fast. We've seen construction, which is a huge employer, weakening fast. We've seen the economic data weakening fast. So at all levels, I think this is still backward looking, and we might still face the same with the inflation numbers that we've got next week, where, I think the Cleveland Fed numbers are looking like they're still going to be strong. So it takes a while for this stuff to come through. Don't forget, we only get one piece of economic data a month, while we get, daily data on every chart, or hourly data, or tick by tick data, depending how much of a degen you are. Here we get one piece of data. So a piece of data is not trend. A piece of data isn't news. You need to take it in context with everything else. In context with everything else, I think that the data is slowing down, and that over time we'll see these employment numbers change as well, because we're seeing everybody laying off staff. I mean, everywhere.
Bitcoin and all other risk assets have taken a knock ever since the employment percentage dropped to 3.7%. This is due to the fact that the economy is looking shaky during these current times. According to Raoul, the number of available jobs is a lagging indication, and the effects of this trend will only become increasingly apparent over time.
The closed-end trust world is something that's been in financial markets for decades. And the lesson I learned from many of these is they can remain at a discount for a long period of time, and it could go further. So, could it trade at a 50% discount? It's possible. So if you are sophisticated and you want to make a bet on that gap closing, whether it's via an ETF or some other mechanism like a bull market coming back and people using GPC trust, go for it. It's not my preferred avenue, but I understand why people might look at it, much like they'll look at futures when they trade cheap as well. It could give you a bit of extra juice. I wouldn't put your granny's life savings into it.
When the price of Bitcoin itself is setting new records for lows, the GBTC, also known as the Grayscale Bitcoin ETF, has been trading at a discount of almost 37%. Raoul says that he can understand why it would look like a fantastic long-term choice for investors, but he warns that there is no assurance that it won't fall another 50% from where it is now. Because of this, it is essential for every investor to learn how to conduct adequate research before making any judgments.
It just is not good kind of fiduciary practice to not allow people to get out of this situation. These things, yes, they were imperfect because there was no rules allowing for an ETF, but there's no real reason why they shouldn't. And what you're actually doing is hurting retail investors, and it's just not fair. It's not right. Think of the bullshit that gets ETF nowadays. 100x leverage crap, short stuff, the inverse Kramer ETF.
Yeah.
I mean, this stuff is toxic waste. And yet the Bitcoin one, they don't allow that. I mean, that's stupid. And you've got a lot of retail investors, a lot of RIAs. It was the only avenue you gave them, and you're purposely screwing them over. It's unforgivable.
Although there are already several ETFs that have been approved and make it apparent that they don't deliver any actual value, such as the inverse Kramer ETF, Raoul is of the opinion that it would be exceedingly unjust to prevent the introduction of Bitcoin spot ETFs.
I think people get confused with what crypto is a hedge against. It's not a hedge against US dollars, because US dollar is the denominator of which most Bitcoin activity changes. Yes, you can trade ETH Bitcoin, but generally speaking, we quote a price and it's in US dollars. So if the dollar goes up, then the price of Bitcoin goes down. It's a very simple relationship. Ceteris paribus, all things remaining equal. It also has been a crappy hedge against inflation. Because inflation, what we've got now is supply-driven inflation, and it is really not what Bitcoin does. What Bitcoin does is debasement of currency. Same with gold. People got very confused with gold, and it's done terribly. The great 1970s inflation, it came back, and we're supposed to see gold go to the moon. It's the debasement of currency where gold goes to the moon. And for that, you need to see M2 growth, you need to see liquidity, you need to see central bank balance sheets rising. We're just not seeing that. We're seeing the opposite. So it's bad. It's a bad environment.
In spite of the fact that a lot of investors consider Bitcoin to be a hedge against inflation, Raoul maintains that it is more accurately a hedge against monetary debasement, exactly like gold. Bitcoin's moment to shine will come when the collapse of fiat currencies is nearly certain to occur, and when people begin to realize how serious of a problem this is.
The dollar, the US is 25% of world GDP. But dollar transactions account for 87% of all transactions on Earth. So the dollar has an outsize versus its actual economic impact. So then when the Federal Reserve tinker around with the supply of money, and they've been reducing it, there's somebody out in the outer world who's like, shit, I can't get my dollars. I call it a game of musical chairs. And the first game of musical chairs was the chair got rug pulled on Sri Lanka. It's the weak borrowers who can't get the dollars. There's less dollars around, and there's so many needs for dollars, so much borrowing goes on, that what happens is everybody competitively bids the dollar higher. I need my dollars. And the people who can't fall by the wayside. They can't pay their debts. So everybody's restructuring with the IMF. This is why the United Nations is talking about the strong dollar. It's a problem for countries who are weak borrowers. Also, the other reason, so the Federal Reserve is taking money out, but the US is also running less of a trade deficit. What is a trade deficit? A trade deficit is the US buying foreign goods with US dollars. Those dollars go into the global system. So if they're buying less foreign goods, or they're selling more of their own goods, what you're doing is taking dollars out. So you've got this perfect storm of dollars leaving the system and people needing them. And it creates this horrible dynamic of the dollar going higher over time.
Even though the US economy only contributes 25% of the global GDP, the US dollar is utilized in 87% of all transactions worldwide, making it by far the most powerful currency in the world. Imagine for a moment that it did fail. The entire global financial system would endure enormous amounts of damage, which would result in a severe financial crisis on a worldwide scale.
The UK has started essentially having to increase liquidity to buy UK government bonds. So we're starting to see the potential turn, but the US is still firmly negative. And until the US cycle turns a bit, we're going to see some stabilization in this monetary cycle. But the probabilistic outcome is we have to live in the next 6 to 12 months forward, because that's where crypto lives. And crypto bottomed in June. And so what it's saying is the rate of change of liquidity is now somewhat improving. It's still negative. So I think crypto gave us the signal that things are changing at the margin, but it's too soon for it to fully drive prices. So I think I was just with an interview with Mark Yusko. He put it really nicely. He goes, crypto winter finished in June 14th and crypto spring started. And spring is muddy, some days cold, some days sunny, some days wet, some days windy. But what follows spring is summer. And we're still in spring. So the market goes up and down, doesn't really do a lot, doesn't feel good for anybody, neither bulls nor bears. And that is the function of the economic cycle starting to turn.
Even the government of England has begun to make a gradual turnaround, as evidenced by their increased purchases of national bonds. Nonetheless, the economic situation in the United States is not improving. It is too soon to tell where we are headed from here, but indications from the cryptocurrency market suggest that conditions are shifting, and it is possible that we may see some rebound in the near future.
The bond market is the biggest, deepest, most liquid market on earth, and it's become illiquid. That's a terrifying thing. Why is that? It's because bank regulation has meant that banks can't buy or add more treasuries to their balance sheet. They have parked all their capital in the reverse repo system, which is another fancy place that you can park money with the Federal Reserve. which is shut out of the market. So the banks can't get involved. The pension system's getting nuked on the 60-40 portfolio, so they were a traditional buyer, they're out of the way. The foreign central banks have been defending their own currencies and have been losing reserves, so they're selling US treasuries. So you have a awkward situation where the biggest, most liquid, the deepest market on earth has no buyers.
The bond market, which is one of the largest and most liquid markets among all of the financial products, has recently come into some issues with its liquidity. Even trying to wrap one's head around this frightening reality is difficult since there is a shortage of liquidity, which implies there are no buyers wanting to get in. Because of this, eventually there will be a sell-off, and the price will fall significantly. We appreciate you taking the time to watch this video. Please give this video a thumbs up and subscribe to our channel so that you can continue to be exposed to content of this nature on a regular basis. I'll see you all in the subsequent one, people.